Scott Karosa, Las Vegas Real Estate and Mortgages, recently shared some thoughts regarding proposal that gives banks more leeway on mortgage bonds. Regulators want to ease a rule that would require banks to share some risk in the complicated mortgage investments that helped cause the financial crisis. Under the proposal advanced Wednesday by the Federal Deposit Insurance Corporation and the Federal Reserve, banks could exempt relatively safe mortgages from the value of those securities. The broad requirements would still have banks hold at least 5% of the securities on their books. But banks now could exempt mortgages issued to borrowers who have debt that doesn't exceed 43% of their annual income. Regulators had proposed exempting mortgages in which buyers put down 20%. But banks complained that would exclude too many buyers with solid finances. Scott Karosa also shared that the proposal would loosen rule on mortgage bonds. The new exemption will encourage lenders to continue offering carefully underwritten mortgages, including those with lower down payments. Frank Keating, President and CEO of the American Bankers Association, said in a statement. As a result, it will help the economy and ensure the largest number of creditworthy borrowers are able to access safe, quality loan products at competitive prices. In the years before the crisis, banks packaged and sold bundles of risky mortgages with low teaser rates that climbed after only a few years. Many borrowers ended up defaulting on the loans when interest rates spiked. As a result, the value of the mortgage securities plummeted. Banks had very little of their own money invested in those securities. That led them to take greater risks that helped stoke the crisis. Mortgages backed by government-controlled mortgage giants Fannie Mae and Freddie Mac wouldn't be subject to the 5% requirement. The two companies together own or guarantee about half of all the United States mortgages, worth about $5 trillion. But there's more, according to Scott Karosa, Las Vegas Real Estate and Mortgages, as set out below. However, the proposal carries an exemption so broad it wouldn't apply to securities containing most mortgages made under today's strict lending standards, which are of relatively low risk. Rather, the rule would apply to the types of higher-risk loans that were popular before the 2008 financial crisis. The rule effectively sets boundaries for what kind of loans might be offered and on what terms, once lending standards relax. Had the rule been in effect last year, at least 98% of loans would have been covered by the exemption, according to Mark Zandi, chief economist at Moody's Analytics. The decision by regulators represented a major concession to the real estate industry and consumer groups that had worried the 5% requirement would hurt the housing recovery by limiting credit.